Let's get across the market open and focus on two commodities that remain in the spotlight. Copper, which is surging on expectations of relentless demand from data centres and the electrification of the planet, while oil is climbing amid those tensions in the Middle East. Let's join Jason Yin from Prime Financial. Jason, welcome back to you. Let's first start with what you're seeing on equity markets at the moment. Particularly, I guess, dominated by news out of the Middle East, but also earnings season having got underway in the States, and also, I guess, some better news as far as investors are concerned with lower than expected inflation stateside.
Yeah, that's right. Look, we're seeing a lot of volatility over the past couple of months, Andrew, with the better than expected CPI prints that we saw in the US last night. Stocks obviously got a little bit of a beat up because they know that the US Fed is unlikely to lift rates anytime soon. And that is quite accommodative in terms of equity pricing. But look, Andrew, there's plenty of headlines this week. But when you strip away a lot of the noise, you said earlier, two themes really stand out to us. And the first one has been physical infrastructure for AI and also around the geopolitical risk in energy markets.
All right. Well, let's begin with what you're seeing with copper. Look, it has rallied to multi-year highs. In fact, we just had some news over the past couple of days. I think the copper mines in Chile are under threat because there are severe storms there, and therefore we saw the copper price actually jump higher. Coincides with obviously production updates from some of the key copper miners here in Australia, Rio and also BHP today.
Yeah, that's right. Look, let's just start on the demand side first. I mean, the biggest misconception today is that AI only benefits software companies, when in reality, AI needs an enormous amounts of physical infrastructure, and that's one of the key reasons that copper has rallied towards the 5-year highs. I mean, look, earlier this week, you've also had Tencent release their new AI model, and demand quickly exceeded the available compute capacity and highlights the need for even more AI infrastructure. AI data centers consume enormous amounts of electricity, which means that there's going to be huge demands for transmission lines, substations, and also transformers, all of which really require really high levels of copper. At the same time, you've also had the combination of high oil, which has pushed a lot of demand for electric vehicles and also renewable energy, and that's expected to continue on to the longer term. On the supply side, you've correctly identified Chile had its own issues. It's grappling with declining oil grades and also production disruption. There's also that powerful winter storm that we saw earlier this week, and that's threatened to interrupt a lot of mine operations as well. So on the supply side, we are seeing a little bit of a constrained in terms of that thematic, but also there's a bit of a structural demand which has kept copper prices pretty high.
So, Jason, as an investor, how can you play this, what we're seeing in the copper market? I guess when we take a look at equities, as I mentioned there earlier, the biggies here being both BHP and Rio. BHP is certainly upping its exposure to the red metal. And then, of course, you've got those smaller players such as Sandfire and ARC.
Yeah, that's right. From our perspective, Rio Tinto and BHP remain the obvious large cap beneficiaries, and they're both positioning copper as a key long-term growth commodity. Rio's latest quarterly reinforced that strategy, highlighting that copper as one of the highest growth priorities through projects like the Oyu Tolgoi assets that they have. For investors with looking for more direct exposure to copper pricing, we do like Sandfire Resources and also AIC Mines, and earnings are pretty much tied to a lot of the increase in copper production that we are seeing from both of those companies.
Now, the other key commodity in focus at the moment is oil, given the geopolitical risks and the heightened tensions in the Middle East. We have seen oil this week jump well over 10%. What's your view on, given that volatility we're seeing at the moment, and I guess once again through that investor lens, how you can play this?
Well, it almost seems like it's Iran Mark II. I remember the conversation that we had probably a month or so ago, where energy prices really spiked and then sort of came back below the $100 mark, and you sort of asked us for our opinion on where we stand in terms of energy markets. And given the fact that getting an off-ramp over in Iran is pretty difficult for Trump, we are seeing a lot of that rhetoric increase again. This time around, Mr. Trump has toughened his stance in Iran and also stepped back from some of the earlier proposals to allow oil flowing through the Strait of Hormuz. At the same time, Iran has also threatened further action against key oil and also gas export routes as well, and that has prompted a lot of traders to price in higher geopolitical risk premium. But the most important thing right now is that we are in a very different dynamic to what we had before. We know that the US strategic oil petroleum reserves are at their lowest level since the 1980s. And also the Russian conflict with Ukraine, that has also seen a lot of Russian exports get disrupted quite aggressively as well. So that means that oil prices have become a lot more sensitive to geopolitical headlines than they have been historically. And we think that holding some exposure to energy markets is probably a good hedge for most Aussie investors.
All right, specifically stock-wise at least, what are you liking at the moment?
Look, we prefer Woodside and Santos. Their earnings and cash flows are highly leveraged to the stronger energy prices. On the flip side, if oil was to remain above or increase to above $100 per barrel for an extended period of time, we'll probably start seeing a lot of pressure on airlines, transport companies, and also consumer spending companies. So perhaps some of, if you have some of those within your portfolio, maybe consider lightening a little bit of that in light of the fact that geopolitical risk is increasing, and we can easily see the $100 mark come back into energy markets.
And Jason, I'm just wondering more broadly in energy at the moment, how you view both uranium and lithium, both having been under pressure more recently.
Yeah, look, uranium is definitely an interesting play. But if you peel back a lot of the hype and FOMO around the increasing uranium pricing, in Australia, there's a lot of red tape for our country to build nuclear power plants across the country. I mean, we're probably one of the best placed countries to actually have nuclear power generation. But given a lot of red tape and a lot of the social economic benefits and cost analysis that you have to step through, it's going to be probably at least 50 years for us to actually get something physical on the ground. So I like uranium as a thematic, but as a longer term play, there's a lot of things that need to work out in its favor before we can really utilize that as an energy generation asset. Over to the lithium side, lithium has been absolutely fantastic with the increase in electric vehicle demand that we have seen. Sure, you can argue that sodium, different chemistries of lithium batteries are going to probably skew the demand for sodium carbonate and also for the demand of lithium as a whole. But if you are looking at some of the analysts' expectations for a lot of the companies that they model, their longer term lithium pricing is actually below the current spot price. It's exactly the same thematic that we saw with the gold play earlier. A lot of analysts weren't really putting in the 5,000 or so gold pricing into their models, and that's why, in valuation wise, a lot of gold equities were a little bit underpriced, and we bought in quite aggressively into that, and now things have sort of shifted. Lithium is a different thematic. Analysts are not putting in the high pricing, and we could see that as a shorter term play when they do have to adjust their models back to where spot is right now.